Boom! What's going on, Investomaniacs? Your boy Knight Rider here, and we're back with another stock update, Robinhood stock market update of the day. Up first, Domino's, the United Kingdom Domino's, is stockpiling pizza ingredients on worries that Brexit could mess up the supply chain. Not good indicator there for Brexit. Not so disturbing. After their worst loss of the year, stocks rebounded decently on Tuesday on hopes that China's currency trade war retaliation won't be as bad as investors thought. Up first, IAC is the venture capital-like public company powering Match Group. That's Tinder and a bunch of other ones. So Tinder, they get all the looks, right? And they are owned by Match Group, whose stock surged 27-ish% today on Wednesday as the dating app's growth jumped again. But it wasn't just Match that popped. IAC shares also rose about 13%. That's because IAC is the parent company and majority owner of Match Group, along with about 150 other brands that you've used probably at some point recently. IAC invests in innovative websites and applications that it thinks has the potential to be viral. These are people-to-people platforms, and shareability is important for IAC in terms of what they're investing in. Recognize these IAC names? Public companies like IAC has launched 10 of them, including Match Group. You probably recognize that one, right? That's Tinder, OkCupid, Plenty of Fish, Match.com, the paid version. It's also Angie Home Services. That's the company behind Angie's List, Home Advisor, and Handy. This is to help connect you with someone to build, fix, repair, or clean things that you can't or don't want to do. Private startups like College Humor, that's aggressively shareable videos. You've probably seen some of their videos on YouTube, as well as Investopedia, that's financial information, kind of the investing encyclopedia, if you will. I personally use this site regularly. They're also owned by IAC. They've also got Ask. Yes, that's formerly Ask Jeeves. You probably used to use that and don't use that anymore. And The Daily Beast, that's news, and there's plenty of more, 100 plus more of these viral-ish digital media that IAC owns. So what's the takeaway? IAC, it's kind of like a venture capital firm, but it's publicly traded. That's unique. Most venture capitalists who get in early to say, your little princess unicorns like Uber or Pinterest, hey, you can't invest in these companies before they go public, right? Only the super wealthy or large institutions typically get access to invest in startups. But IAC is different. It's like the Berkshire Hathaway of tech kind of venture capital investing, giving retail investors access to a portfolio committed to a specific theme: digital interaction. Match Group is performing so well, it's kind of making me sad. I sold the darn thing due to slowing top-line growth, because in spite of that, and you know me, I really go for that supercharged top-line growth, but geez, Match is just such a fantastic, solid company. If I ever lower my requisite kind of desire for top-line growth, Match Group will certainly be in the consideration. I'm always cautious to buy a stock after it jumped so significantly as it has today. You might want to wait for a little bit of a pullback, but Match Group is still a cash printing machine, and IAC is very cheap. I would definitely recommend IAC. Up next, Disney stock falls about 5 to 6% as its acquisition spree catches up. A chain is only as strong as its weakest superhero blockbuster. Disney just announced that revenues hit a record high of $20 billion. That's up 33%, but profit dropped 51% in the second quarter. Now, that Disney has officially acquired Fox and most of Hulu to add to the House of Mouse, you have to look at the good with the bad. There's a lot of good, but there's also some bad. Here are some of the good. It's mostly kind of Disney OG stuff. Avengers Endgame became the best performer in movie history. #1 of all-time box office if you don't account for inflation. And ESPN and Discovery channels brought home big bucks. The bad, mostly that Fox acquisition. Hey, I'm a huge Wolverine fan, but can we be honest, that most recent X-Men movie, Dark Phoenix, if you haven't seen it, it's basically 2 hours of that chick from Game of Thrones saying, I don't know what I'm gonna do with all this power. Also, winter is coming. A whole grip of cricket matches. Yes, you heard that right. Cricket matches. You know, over there in the UK and England where they play, with the bat and they hit the ground. I don't know. I don't really know how cricket works, but the point is, apparently it's popular over in Europe, and a whole group of them got canceled due to rain, and that hurt international revenues for Fox's TV, which was going to be showing that. Going forward, Disney wants to resurrect Fox's Home Alone. Good idea, Disney. I think Home Alone reboot would be hugely successful. Here's what Disney does. Mickey lives off for-profit food groups. Everybody, they kind of tend to forget how vast Disney is. They just think of Disney as like it's just the box office hits, or it's just kind of like a couple TV channels. I mean, it's a lot of things. You forget it's not just the box office. It's actually, the box office is only about 18% of their overall revenue. So here's the 4 primary groups you can fit it into. #1, media networks. That's 33% of revenue. This is all of Disney's many cable TV channels, which include major channels like ESPN and ABC, and those had solid performance this quarter. Second, parks, experiences, and products. That's 31% of revenue. Attendance fell 3% at Disney's U.S. parks, but per tourist spending jumped 10%. So overall, a nice little increase. This could be the disturbingly large turkey legs, which are a whopping £1.50, and they're pretty darn expensive. So that's probably why, the per tourist spending went so much. I mean, these things are massive. Hey, that's way more turkey than most people eat for Thanksgiving dinner. You know that? Average Thanksgiving dinner is 1.25 pounds of turkey. These things are 1.5 pounds of turkey. And of course, also in your parks and experiences category, you have the Disney Cruise Line. Up next, #3 is studio entertainment. That's 18% of the top line. Rebutter the popcorn for Disney's hits on hits on hits. The movie studio had a record $3.8 billion of revenue. That's all those big box office hits for you. And #4, direct to consumer. That's also 18%. That's like Hulu and the new home for Disney Plus. That will also be in that direct to consumer category. The much hyped new streaming network that arrives very, very shortly here in November. Hey, I'm looking forward to that myself. Are you looking forward to it? I'm looking forward to it. What's the takeaway? Disney Plus doesn't actually have to make money. That's the secret. This new Netflix rival just needs to feed the overall Disney beast. Remember, Disney's not just one thing. Disney makes money everywhere. They're like Amazon Prime Video in that way. And they also, like Amazon Prime, will have that huge advantage over Netflix. Netflix has one product, and it needs to make 100% of their profits from that one product. And Netflix is $12.99 per month. Disney Plus can charge only $6.99 per month because the more fans that fall in love with Coco, the more Disney can make money off those theme parks, toys, box office hits, cruises, etc. P.S. The brilliant Disney CEO Bob Iger just announced the mega package of Disney Plus, Hulu, and ESPN Plus, which will cost $12.99 per month. That's right, you'll be able to get Disney Plus, Hulu, and ESPN Plus for the same price as Netflix alone. All of a sudden, Netflix is sounding a little expensive. It must be noted that this is the ad-supported version of Hulu, which only costs $5.99 per month as a standalone product. But gee, that's an awfully good deal compared to the standalone price for Netflix of $12.99 per month. Disney Plus will cost $6.99 per month. And so if you combine that with the standalone Hulu, which is ad-supported, your total cost is going to be $12.98 per month. So you're basically getting ESPN Plus for absolutely free, provided you care about ESPN Plus and you're okay with the ad-supported version of Hulu. That's a pretty sweet deal compared to Netflix. I personally am willing to pay more for the ad-free version of Hulu, which is $11.99 per month, but I absolutely love the fact, as a would-be investor, that they have a cheaper ad-supported version. This is a significant advantage Hulu has over Netflix and HBO. This is also one of the reasons I like YouTube. It has a 100% free ad-supported version, but then also has an ad-free paid version, which I personally use. I would like I would take this stock drop as a buying opportunity for Disney. Hey, you're getting a nice little dip in the stock here. I like that, especially ahead of the release of Disney Plus. I think investors are going to be pretty excited when we start getting some numbers rolling in on Disney Plus. I think that we're going to be beating expectations, at least the expectations that Disney is putting out in terms of subscriber acquisition early on. Netflix stock, on the other hand, is down about 3% on the news. I would not take that as a buying opportunity for Netflix. I've been negative on Netflix for a while, at least in terms of the short term. I still like the long-term story, but really it's not my preferred stock to be in. So, I wouldn't take this little dip as a sign that's a good deal. I'm like, yeah, I'd probably still stay out of it. Competition is really heating up for Netflix. Up next, Barneys is going bankrupt, but this has a different retail lesson. Bankruptcy is the new black. Among department stores, Barneys was the fancy New York City option. There was only 22 locations and a cooler than you kind of vibe. It's a private company controlled by a hedge fund, but we can still learn a little something for it. It's shutting down 15 stores and entering Chapter 11 bankruptcy. Barney's biggest locations will keep the doors open while a judge figures out what to do with it. Makeover, anyone? Barneys has been here before, going through bankruptcy in the 90s. But if it reemerges from bankruptcy again, it will do so promising to focus on experiences. Because us millennials love our experiences. Barneys says it's adding more in-store restaurants and entertainment, well, whatever that means, because they haven't really given us a whole lot of details on what exactly that does mean. What's the takeaway? Do you own the real estate? This has a lot to do with real estate. Barney's core problem is it doesn't own the land that the stores sit on. And they are in New York City, which is some of the most expensive real estate in the world, at least in America. Last year, the rent at Barney's flagship Madison Avenue store jumped $2.5 million a month. Those costs can kill. Meanwhile, rival Saks Fifth Avenue may also be suffering from the retail apocalypse, but it owns most of its land, including the iconic Fifth Avenue spot. So, although the retail may not be doing super well, it is benefiting from the rising real estate values of which it sits on in that valuable New York real estate. Hey guys, that's it for this video. Let me know what your thoughts are, or if there are any other stocks you'd like me to check out. I appreciate all the likes, comments. Thank you so much, and make sure you subscribed to Investomania, brother.